Hello and welcome. In this video, I'm going to walk you through an FPAT Reserve Study Report. If you're considering working with us, this will give you a clear look at what's included in a typical report and how it's structured. And if you've just received your reserve study, this video will serve as a helpful guide to understanding the key sections and how to read the information with confidence. By the end, you'll know exactly what to expect, where to find the details that matter most, and how to use your report to make informed decisions for your community. The sample report we're reviewing today is for a condominium association. However, if your property were a cooperative, a homeowners association, or even a commercial building, the overall format would look very similar. Let's start with the cover of your reserve study report. Right here on the front, you'll see two key pieces of information that set the foundation for everything inside. First is the level of engagement. This tells you what type of reserve study you've received, whether it's a full study, an update with site visit, or an update without site visit. Knowing the engagement level is important because it explains the scope of work that went into preparing your report. Second is the budget year for which the study was prepared. This lets you know exactly which fiscal year the numbers and projections are aligned with, so you can be confident your planning is based on the right timeline. With those two details, the engagement level and the budget year, you'll have the context you need before diving deeper into the report itself. After the cover page, the next two pages you'll see are the letter of transmittal and the table of contents. The letter of transmittal serves as a formal introduction to the study. It includes key details such as the report's publication date and the date of the on-site analysis. The report is prepared in compliance with the Community Associations Institute's National Reserve Study Standards. You'll also see the name of the senior manager who reviewed the study. This individual holds the Reserve Specialist designation issued by the Community Associations Institute and brings many years of experience preparing reserve studies. The next page is the table of contents. While it requires little explanation, it serves as a quick reference guide to the different sections of the report. The following section, the Reserve Study Summary, provides the clearest overview of the entire study. On the first page of the Reserve Study Summary, you'll find key details including a full description of the property, the reserve specialist who performed the on-site analysis, and the date that analysis took place. The most critical item on this page is the unaudited beginning balance. This figure represents the total reserve funds the association is projected to have on hand at the start date of the report. The beginning balance is either provided directly by the association or calculated by the reserve specialist after reviewing the most recent financial statements and current budget. Because every financial projection in the study is based on this number, it is essential to confirm its accuracy when reviewing your report. The next paragraph outlines the funding methods presented in this report. There are two acceptable approaches to funding reserves: the component method, often called the straight line method, and the cash flow method, commonly referred to as pooling. It's important to note that if your association currently uses the component method, the report will display both the component and cash flow methods. However, if your association already uses the cash flow method, only the cash flow method will be shown. If any of this terminology seems confusing, don't worry. All of these methods and terms are clearly defined later in the report. On the next page of the Reserve Study Summary, the key information is presented in a list format. You'll also see a brief disclaimer explaining why certain components may be excluded from the report. Moving further down, we come to the component results and the financial parameters used in the report. This section shows the total number of reserve components identified, along with the current replacement cost of all components in today's dollars. Below that is the future replacement cost of all components, but in that case, the totals also include adjustments for inflation. Next, the projected beginning reserve balance is shown again, followed by the assumptions used for inflation, interest earned on reserve deposits, and taxes on interest income. Of course, we cannot predict the future with certainty, so these figures are based on reasonable estimates. Because the inflation and interest rate assumptions are applied to financial projections spanning 30 years, we recommend using stable and realistic values. The final page of the Reserve Study Summary presents the funding plan results. Every reserve study we prepare includes two pooling strategies, along with a straight-line strategy if the association is currently using that method. This sample reserve study presents all three funding strategies, arranged from the riskiest to the most conservative. It's important to note that all of these funding plans are considered acceptable and comply fully with Florida's rules and regulations. Strategy A is the baseline funding model. This pooling approach ensures that cash flow remains positive over the 30-year period. However, in one or more years, the year-end reserve balance may come very close to zero, leaving little margin for error. Because of this, the strategy carries a higher risk of leading to future special assessments or the need for bank loans. Strategy B is the threshold funding model. Like the baseline approach, this pooling method maintains positive cash flow over the 30-year period. However, it also requires that the year-end reserve balance never falls below a specified dollar amount or percentage, known as the threshold. This added safeguard provides a greater margin for error, and the threshold level can be adjusted at the client's request. Threshold funding is also the strategy we typically recommend. Strategy C is the component funding analysis. This approach uses straight-line calculations for each reserve component based on current costs, without factoring in inflation or interest income. As a result, it provides only a one-year snapshot that is valid for the first year of the funding plan. This method typically leads to the highest contributions and offers the least flexibility. The annual contributions required under the component funding analysis can vary significantly depending on how existing reserve funds are allocated across the components. Our report provides recommendations on how these funds could be reallocated to help minimize annual contributions. While this allocation may differ from your current plan, it should be carefully considered if your association chooses to continue with component funding. Before making any reallocation of reserve funds, consultation with your legal counsel is strongly recommended. Now that you're familiar with the three funding strategies, let's review the key information shown for each. One important item is the special assessment requirement. If current reserves are too low to support funding with reasonable contributions and steady increases to keep pace with inflation, the funding plan may recommend a special assessment or loan in the first year. For each strategy, the initial year's required contributions are shown in three ways: annual, monthly, and average monthly per unit. A common question we hear is whether these amounts are in addition to your current reserve contributions. The answer is no. These figures represent the total recommended contributions, not something to be added on top of what you're already contributing. The remainder of the report is what we like to call the meat and potatoes. All of the detailed supporting data used to develop the funding plan results presented in the reserve study summary. We'll begin with the cash flow financial reports section. This section opens with a cover page that outlines the financial parameters used to create the 30-year cash flow projections. 4 key assumptions are applied in these reports. First, the annual contribution increase represents how much reserve contributions will rise each year to offset the impact of inflation. In most cases, this percentage aligns with the inflation rate applied to reserve expenses. For reference, our inflation rate is based on the average CPI over the past 30 years, because the best way to project the future is to study the past. Next, we apply an interest income rate to the association's reserve investments. We take a conservative approach here, since interest rates will inevitably rise and fall over the 30-year period, but it's still important to account for some interest income. Finally, the association is assumed to pay taxes on that interest income, which we set at 30%. Cash flow reserve funding, or pooling, works by treating all reserve expenses as one combined fund rather than saving separately for each component. Contributions are planned, so the reserve account always has enough to cover upcoming repairs and replacements when they occur. The expenses shown in each year of the cash flow projection line up directly with the expenditure report for that same year, which can be found later in the report. After the annual contributions, interest income, and any additional capital are added to the beginning balance, the year's expenditures are then subtracted, giving you the ending balance for that year. Once these calculations are completed for all 30 years of the projection, the key requirement is that the year-end balance never falls below zero. This approach spreads costs more evenly, provides flexibility, and usually results in lower required contributions than the component method. In this sample report, the first cash flow funding plan presented is the baseline strategy. Every cash flow plan has a risk year, the year in which the ending balance is at its lowest point over the 30-year projection. The lower that balance, the riskier the plan. In this example, while the year-end balance never falls below zero, it drops to just $11,384 in 2046. With so little margin for error, the baseline strategy is considered a risky funding plan. The second cash flow funding plan presented is the threshold strategy. Its calculations work the same way as the baseline plan, but with slightly higher annual contributions that create a more conservative risk year. In this sample report, the year-end balance in 2046 is $296,687, giving the association a comfortable contingency for unexpected expenses. This is the funding plan we recommend. It's also important to note that we offer 2 free revisions at no additional charge, so the threshold amount can be easily adjusted during the revision process. To clarify, any revisions to the reserve study must be requested prior to the report's effective date. Once the association has entered the fiscal year for which the report was prepared, the revision period has closed, and any changes to the funding plans would require submitting a new update request. The final funding plan in this sample report is the component funding analysis. This method uses straight-line calculations for each individual component, with annual contributions determined by dividing the unfunded balance by the component's remaining useful life. In this method, funds are tied to specific components and cannot be reallocated without a vote of the members, which can make the process challenging for many associations. Because this plan places so much emphasis on the remaining balances, the way funds are allocated ends up driving the annual contributions. This is different from the cash flow model, where the contributions are based directly on projected expenses. For this reason, the reserve study often recommends reallocating reserve funds to achieve the lowest possible annual contributions. Reallocation also becomes especially important when new reserve items are added to the budget. This funding plan requires the association to fund each component at 100%, which usually results in the highest annual contributions of all 3 strategies. The next section of the report includes charts comparing the different funding strategies. You'll see that in years with major expenditures, the ending balance declines. These charts align with the cash flow and component funding plans reviewed in the previous sections. Notice how the blue line, representing the baseline funding strategy, drops close to 0 in 2046. These charts provide a clear visual of the level of risk associated with each funding strategy. The chart on the next page shows how the percent funded for each strategy rises and falls over the 30-year projection, compared to the fully funded level of 100%. Notice that the yellow line, representing the component funding strategy, stays close to 100% throughout the entire projection period. The next section of the reserve study provides a detailed list of all projected reserve expenses over the next 30 years. To account for future costs, an annual inflation factor is applied to each expense. The annual expenses shown here correspond directly to the annual expenses included in the baseline and threshold cash flow reports presented earlier. The next section provides a table listing all identified reserve components, organized by category. This format makes it easy to view the key details for each component without the need to scroll or search through the report. For each component, the table shows the first replacement occurrence, basis cost and quantity, which together calculate the current cost, useful life, adjusted life, remaining life, and the future cost at the first replacement cycle, which reflects inflation adjustments. Let's pause to address a common question we often get. What does adjusted life mean? Take a look at the stairs in this summary report. Stair replacements are divided into 2 phases. While the estimated useful life of stairs is about 50 years, in this case, they aren't scheduled for replacement until they reach 53 and 54 years of age. That's why the adjusted life is shown as 3 years and 4 years. The final section of the meat and potatoes is the most detailed, which is why it's called the reserve component details. This section provides in-depth information about each reserve component, details you won't find anywhere else in the report. Now, let's take a closer look at the component detail for the stair replacement we discussed in the previous section. Here you will find additional information such as the asset ID, its current condition, detailed notes on the component and its scope of work, the different project phases, and even photographs of the component. If a lump sum was used to estimate the cost of a component, this section will often include a detailed breakdown showing how that price was determined. The final section of the report provides explanations and definitions of all the terms used throughout the study. We hope this video gave you a clear and useful understanding of your reserve study. Thanks for spending a few minutes with us. Your reserve study is an important tool for planning ahead, and with this video, you'll know exactly how to use it. And remember, you don't have to figure it out alone. We're always here to answer your questions.